Okay, good morning and happy Tuesday, and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we are at a pretty pivotal moment here in the broader markets because we've had quite a bit of strength here for the past few trading sessions that invalidated some of the downside bearish tone to the markets, but we're not out of the woods yet. So I want to share with you my charts and how I'm currently viewing the broader market. So let's go ahead and get started. But before I do, what we're going to discuss here is for education and demonstration purposes only. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll take a look at the US market update here to show you where US equity markets currently sit. Like I said, we're at a pretty pivotal moment here. But when we look around the world, when we look at global markets, we're seeing a fair amount of weakness across the board. Europe, Asia, Latin America. So I want to share with you some of those charts to show you just exactly how much weakness we see globally, and that could spill over potentially into the US. We'll take a look at fixed income and commodity markets. What are the rate markets currently doing? Gold and silver, we'll talk a little bit about that and some opportunities we see from a commodities perspective. Then we'll take a look at some of the economic indicators with the US recovery, from durable goods to where the reopening trends currently are. Where is their consumer spending, where there is some decline here in consumer spending. And then we'll share with you our ideas. And if we have a few minutes at the end, we'll answer any questions that you guys have. So the primary question that we've been getting over the past couple of days is really, are the markets back into a bullish trend? We certainly have seen a lot of strength here over the past 3 trading sessions, Thursday, Friday, Monday. We've seen a bit of pause here on today's open. So, is this just a pause before we continue moving higher, or is this a bit of a bear market rally here? So let's take a look at the global markets and hopefully help you answer those questions. So I'm going to share with you my technical charts, my economic research, and the ideas that we have to inform our directional outlook. So when we look at the Qs, we are certainly back above that 270 level here, which is a major line in the sand. We broke below that level, or we tested that level on the initial plunge, broke below that level, but within just a few trading sessions, managed to hold those 260 lows and started to resume back into the 270 level back above. Now, the question here is whether or not that stops this downside trend. Now, while it may put us into much more of a neutral state here between this 260, 280 level here, but this remains the fact that we are still below those highs that we had from that initial bounce. That was in the 280, 282 level. So we have 2 major resistance level here to the upside that we have to break above in order for us to resume an actual bullish trend. What we have done over the past few trading sessions is simply stop the short-term bearish trend, but we have not started a bullish trend just yet, especially if we look at the NASDAQ 100 index. If we look at the SPY, we have a very similar picture, but slightly weaker outlook here. If we look at the SPY, we're starting to see a bit of a head and shoulders formation form here on a small term daily chart. So those resistance levels here sit around that 343, 342 level. So the S&P 500 has about another 10 points higher to get to break out above that level for the S&P to resume its bullish trend here. So S&P looking a little weaker here, especially as you kind of start to see this downside channel form, and it's still holding that downside channel. An equity market starting to take a pause here. As you can see, momentum looking fairly weak. Daily flow, daily money flow looking weak as well. When you look at the weekly charts, you start to see what looks like also like a longer term head and shoulders formation, and this 340, 360 levels start to form. And the question is whether we're going to approach that right shoulder and start to fail, or if we're able to break back above it and resume this bullish trend. But so far, the 20-week moving average has held here on the weekly chart. So you do have some support coming up here, but certainly on more of a weaker foot here. And we need to get back above some major levels to say that we're resuming this bullish trend. As of right now, we're still in this kind of neutral, choppy trend here at the moment, but we are seeing a little bit of strength here. When we look at the small caps, this is where we start to see continuing what we saw here in the US, in the S&P 500, which is a small downtrend starting to form here. We need to really get back above 152 to kind of negate that downtrend. We need to get back above 160 to start resuming that longer term bullish trend. So here on the small caps, looking less and less likely for that resumption of that bullish trend. If we look at RSP, which is the equal weight S&P 500 index, we basically see the exact same downtrend starting to form. Haven't seen a breakout here above this level here. We would have to get back above that 112 and a half level for this bullish trend to resume here. So as you can see on all of these global markets, what we're seeing, or I'm sorry, all of these US major indices, what we're seeing is this slow topping formation starting to form. We've invalidated that the topping formation is complete and we're starting to move lower. We're still back in this kind of neutral territory, but a lot of these markets are on the cusp of potentially either breaking out to the upside and validating this topping formation, or completing this topping formation and allowing us to start continuing to move lower here. So over the next couple of trading sessions and the next few trading weeks, I think we're going to get a lot more clarity as to where markets are headed next. But when we look at the volatility numbers, this is really where we're starting to continue to see declines in terms of volatility, retreating from that $40 level on VXN, which is the NASDAQ 100 volatility indice, the 40 level providing a fair amount of resistance here. So now we're starting to resume here to the downside. But overall, as you can see, the volatility continues to climb on the average volatility over the past few months here. This is what we expect going into election. We have a debate here tonight that's partially causing some of the pause in the strength we've seen in the equity markets over the past few trading sessions. A lot of investors looking to look for a little bit of clarity from that debate. I'm not sure that we're going to get a whole lot of clarity, but certainly adding to some of that volatility. We also have started to see a bit of an acceleration here to the upside in terms of call buying. So that 20-week put call ratio that we've been talking about, that's continuing to improve and getting back to more normal levels. They're starting to pause a little bit here. The question is whether we're going to start to see more call buying. That could be one of the catalysts that drives equity markets back above some of those resistance levels that we're talking about. But those resistance levels remain the key levels that we have to get back above in order for a bull market to continue to resume. When we look at so that's what we just looked at here for the US markets. Now, when we look at the global markets, that's when we start to see quite a bit of weakness here. If we look at the Euro, the Stoxx 50, which is predominantly Germany and France, as you can see, it's still trading below its 200-week moving average here, which has provided a ton of resistance. And now, since it started to test that 200-week moving average, which also coincides with the 200-day moving average, it's recently started to show some weakness and continue to move lower here to the downside. So can everyone hear me? It looks like there's a couple of complaints about audio issues. If you can hear me loud and clear, please type 1 into the chat window. If you're having audio issues, please type 2. Okay. Looks like all ones. Okay, great. Sorry, just wanted to test that. So when we look at the Euro markets, we're starting to see a fair amount of weakness here. We've recently broke below this bullish trend line here. And arguably, when markets are moving sideways, when the U.S. markets are moving higher, not only is this losing ground on a relative basis, on an absolute basis, but it's certainly losing ground here on a relative basis. So if you see the daily money flow looking fairly weak, the weekly money flow also looking fairly weak, no progress here from a momentum perspective, actually continuing to move a little lower here. Daily momentum also starting to move lower. So if we look at European markets, certainly not seeing the strength that we're seeing here from the US equity markets. When we look at the Asian markets, we look at Hang Seng, we see the same thing. Hang Seng actually trading below its December 2018 lows here. So multiple lows that it could not manage to get back above. It, for a few months tried to break out, but really failed at that level and has now started to turn back lower here. So Hang Seng, Chinese equity markets in terms of Hong Kong looking fairly weak and looking like it could continue moving lower. If you look at momentum indicators, look at money flow indicators. And lastly, if you look at names like Brazil, which is one of the few leading equity markets to the US equity markets, starting to turn lower here, failed to regain that prior high here around that $33, $34 level here. So lower high, and now a breakdown below support level. This was on some news yesterday about some social programs that they want to launch here to counter the loss of income here due to COVID-19. This is putting a drag here on the Brazilian markets here. So when we look across the globe, Europe, Asia, Latin America, we're seeing the same type of weakness across the board. There are a few exceptions to this. We see Japan still holding some of the major support levels. We still see some select markets around the world, but if we look at the major markets, we're starting to see this weakness continuing to form out of the equity markets. Is this a preview for what's going to happen here in the US? Certainly US is not immune, especially as we are a global economy here. So this is some of the downside risks that we start to emerge, that we're starting to see emerge from peripheral markets that usually typically turn lower first before the US equity markets turn lower. So keep an eye out for some of those weaknesses around the world. When we look at TLT, we continue to see slightly bid here for US Treasuries, meaning flight to safety for some of these Treasury bonds, while outflows from HYG, which is high yield, and LQD, which is investment grade bonds. Over the past few weeks, we've seen some significant outflows on those ETFs and into some of the Treasury markets. This also speaks to the fixed income markets providing a little bit of a warning sign in terms of risk off or taking some profits on some of the riskier assets and placing those assets into safer assets like Treasuries. And that provides potentially an opportunity here for gold again, because as Treasury rates continue to decline, as there's a flight to safety in Treasuries and drive rates to zero, this puts gold and silver back into the picture, which predominantly has been on the sidelines, you know, in a sideways motion, and last week started to break to the downside. I think you probably saw some bearish potential here for gold. But if we look at the long-term chart here, gold has approached that 20-week moving average again, which has been a consistent opportunity to look for long positions here. So after a bit of a parabolic move, it's now consolidated back to that level, and this could be, you know, the start of a potential opportunity to build another long position here for gold. So if you look at that long-term chart, it is potentially an opportunity for a long position here for gold. And on the daily chart, looking severely oversold. So those are all the reasons that we're taking a look at gold again here, especially now that we've had this break below that support level. When we look at the economic picture here, we continue to see a fairly mixed recovery. We continue to see manufacturing continue to surprise the upside here. But one of the things that has been significantly strong in driving some of the consumer spending rebound that we've seen is really durable goods, because we know that consumers are still spending, and they've shifted their spending away from travel, from services, to more investments into the home, durable goods. Home Depot, Whirlpool, these types of names have seen significant headwinds as a result of it. So durable goods is a big driver of the reopening or the reopening trade here. But this month here, a survey was a 1% growth, actual was 0.4, so significantly lower than expected. This is one of the riskier parts, in my opinion, to the economic recovery from a consumer spending perspective. You know, are consumers starting to pull back a little on this front? You know, durable goods certainly is a potential indicator to keep an eye out here for that. And I think another chart that really speaks to the weakness that we've seen here over the past 3 to 4 weeks really is the probability investors have put on the new stimulus bill. So this is only a bill of $750 billion or more. A lot of the stimulus bills that the Democrats have put forth is in the $2 to $3 trillion range. So this is talking about just a fairly small stimulus bill. And just until the beginning of September, the probability of the markets were still putting at about a 90% probability that this was going to happen sometime between August and October 1st, so before the election. Over the past 4 weeks, that number has plummeted down to just 18%, and 77% now believe that that's not going to happen before January 2021. So significant shift in investor sentiment here over the past 4 weeks. So the fact that we are roughly back to where we were at the beginning of September, and when we have this huge shift in terms of where we believe stimulus will actually flow back into the economy, this also is some of the downside risks that I see in the US equity markets. Now, when we look at the recovery, we talk about reopening trades. You certainly have airlines, cruises, hotels, restaurants. These are the type of stocks that we typically look at from that perspective. We're starting to see more of a bifurcation on this front, and it's not particularly surprising, which is that dining continues to improve. It's one of the categories that continues to see fairly consistent uptick in terms of the number of people that feel comfortable going back to a restaurant and dining out. Speaks to the decline in terms of the coronavirus, speaks to a little bit in terms of consumer sentiment. But if we look at airline passengers, this has relatively been flat here over the past 2 to 3 months here. We haven't seen this significant uptick here. Corporate travel is still at a standstill. And the one indicator that is a little surprising to us is actually that hotels have started to see a decline here over the past few weeks here, both in terms of occupancy, in terms of the daily rate, and the revenue per available room. These are all metrics that the hotel industry uses to track. We saw a fair amount of recovery here over the past few months, but over the past couple of weeks, we started to see a decline here to the downside. So that drives some of the bifurcation that we continue to see even within the reopening stocks. So those are some of the names to pay attention to. So what I wanted to do from an ideas perspective is not just necessarily show you the ideas, but also give you an idea as far as how I'm thinking about the major stocks that drive some of the US economy and the major indices. If you look at names like Microsoft, we're starting to see what looks like, similar to what I showed you in the equity markets, is the start of what looks like a head and shoulders formation, where we're approaching this 218 shoulders line, where the question is whether or not these names will hold these levels as resistance and potentially start to roll over, especially if you see a break back below the 200 level. That certainly starts to put some of these big tech names under pressure. But if you see a breakout here above this 218 level, that really resumes this bullish trend here for technology. So we are at the cusp of this 215, 218 level, and a lot of major names. If you look at Apple in that 118, 120 level, similar type play here, where we're approaching this right shoulder, if you will. And the question is whether these right shoulders will hold or that we will break back above it, invalidate this, and equity markets can resume that bullish trend. So over the next few trading sessions, I expect to see some strength from the equity markets start to test those levels. Pay attention, because that, I think, in my opinion, is going to give us a strong outlook into where the direction of the US equity markets and perhaps even technology is headed in the near future. We see the same pattern across many of the major technology stocks, so pay attention to that. On the flip side, we also still see quite a few of the industries that have largely invalidated this topping formation and has started to resume that bullish trend. Semiconductors being one of those. So semiconductors not really having that topping formation, continuing to have higher lows, higher highs, and resuming that continuation higher here. So it's not that every industry is in this particular category, but I will say that there's only a handful of categories that continue to fall into this camp. Consumer staples certainly still remains in that particular camp, where you have a series of higher highs, higher lows, and starting to break back above some major resistance levels here. Costco last week on earnings, fairly weak, started to see a lot of strength here over the past couple of trading sessions and starting to test some of those major resistance levels. So again, we don't see the same picture across the board. Technology looking fairly weak, but we're starting to see some of this rotation into industrials, into semiconductors, into staples that have seen some of this strength. Even financials looking fairly strong here. But if we look at some of the hotel names like Las Vegas Sands, specifically a lot of exposure here to Vegas, where convention numbers have been virtually zero and stays at zero, and expects that even within 2021 to be extremely weak here. So Las Vegas Sands moving sideways, not only moving sideways on an absolute basis, which means that on a relative basis, it's starting to underperform. So when we start to see some strong rallies here over the past few trading sessions, these are rallies that I see as opportunities to fade that strength Look to use strategies that sell high volatility, such as call credit spreads or cover calls if these are stocks that you own at these types of levels that can provide you with some income if these markets move sideways or start to drift a little bit lower. Even if they drift a little higher, you can probably still make a little bit of money selling these call credit spreads. But wait for these stocks to move to fairly short-term overbought levels before you look to sell. But there are plenty of names that fall under this camp where you've seen this stock where the stock has moved basically sideways on an absolute basis, which means that it's continuing to decline on a relative basis. Those are the types of names that I would pay attention to. Another one that falls under this camp is American Express. You have American Express that predominantly sits at the intersection of corporate travel and corporate spend, and as well as higher income brackets. Now, both of these categories are the categories that we see from a spending perspective that have seen declines year over year. It's really the lower income that has continued to keep up their spend, actually increase their spend in terms of year over year. But if we look at the higher income, we look at corporate travel, significant declines year over year. So when you look at American Express, that is kind of at the intersection of these two brackets compared to Visa, MasterCard, PayPal. These are those names that I, again, see further weakness here from not only on an absolute basis, but on a relative basis. So even though we are starting to see this rotation slowly into financials, it's a very slow rotation, but it actually is there, that we are seeing financials continuing to outperform the broader markets. And financials still one of the weakest sectors, but starting to turn that around. But this is really one of the intersections within XLF that I think is starting to see some more weakness here. So that covers what I wanted to share with you here today in terms of how I'm viewing the markets. Like I said, currently we're sitting at a pretty pivotal moment here for US equity markets. Global markets looking fairly weak, perhaps providing a little bit of a glimpse into what's the future of US equity markets. But we are at that pivotal moment. Over the next few weeks, we will continue to update you on any changes to that outlook, especially if markets hold those resistance levels or break above those resistance levels. That provides us with our strong directional outlook. So at the moment, weakness here, fairly neutral here in the markets, looking for balanced bullish and bearish opportunities, bullish opportunities in very strong stocks and strong sectors, weak stocks and weak sectors for bearish opportunities. Those are the names that we'll likely highlight on our daily plays. So continue to look out for these the daily plays, as well as these market outlook sessions, to provide you with that guidance and outlook that we're providing. So thank you so much for supporting us and allowing us to continue doing this, especially to our members. For those of you that do not have access to OptionsPlay yet, you can sign up for a free trial at OptionsPlay.com. And if you are on a free trial, and I would if you are on a free trial, I hope that you consider supporting us and becoming a member, which is only $75 a month or $500 a year. So with that, that covers what I wanted to share with you. I have a few minutes to answer some questions here. If you have a question, please type them into the chat window here. Sunil is saying hotel occupancy decline here could be due to school reopening. Sunil, you're absolutely correct. That definitely has a bit of a seasonality to hotel occupancy, but what we're seeing is not just occupancy, we're seeing daily rates and revenue also decline as well. So that doesn't speak so much as to the school reopening per se. So I agree with you, but there is still some weakness that we're seeing out of the reopening trades. eBay's showing a fair amount of strength here and invalidated some of these levels here, but notice how eBay's still just at the cusp of this major support level. So this level has been support here, this $54 level, for quite some time. It's acted as resistance. If it can get back above 54, that certainly invalidates this bullish trend here. But if it gets rejected, I think that eBay is headed back lower here. Nilesh is saying, can you please send? So I've gotten a lot of questions here regarding my chart settings here. So if you want to send me an email at info@optionsplay.com, I can send you my chart settings so that you can have similar chart setups on your own platform. What do I think about Dominion Energy? So certainly on the weaker side of things, you certainly have this short-term support level here that is held for quite a bit of time, that is now broken and retesting as resistance. So more likely to see further downside here on a name like Dominion. I have a bad habit of staying in a trade until all is lost when it goes against me. When is the time to get out? So Bill, I think you have a very similar experience to a lot of investors who start out with options trading, holding on and hoping. The best strategy for that is for each individual strategy, there are different rules as to when it's best to take profits and cut losses. So it depends on your strategy, but if you're buying calls or puts or buying debit spreads, anything that's a debit, you usually want to cut your losses when you've lost 50% of the premium that you pay. So if you buy a call option for $1, once it's trading at 50 cents, it's time to cut those losses and move on. So look at individual strategies and what the rules are for taking profits and cutting losses. Do you also look at the front week and front month premiums on VIX to inform what VIX options are predicting from the market outlook? So we don't look at front week, we look at front month and back month. So we look at the 3-month VIX to the front month VIX. So we look at the VIX 3M divided by the VIX. We look at that ratio, and right now it's trading at 1.18, which means that this is a fairly normal ratio where the front months are trading below the 3-month VIX. Front month VIX is 26, 3-month VIX at 31. So this is a fairly normal level. When we start to see front month VIX elevate beyond the back month VIX, that's really when we say markets are a bit more stressed. So we do look at that term structure, but we look at it slightly differently. So Sanjay, I've already spoke about gold and silver, and my thoughts are we've returned back to that 20-week moving average. That, I think, in my opinion, is an opportunity to look for a long position. What will be the leading indicator return to air travel? So the best real term, I think there are two that you want to look at from a travel perspective. There's bookings, and then there's TSA throughput numbers. So bookings tells you where we are, which airlines have seen a return in terms of leisure travel bookings. The other thing I would look at is TSA throughput numbers. And the other thing is corporate travel. Corporate travel is still at virtually zero. So until corporate travel starts to pick up, I don't see a good underlying thesis for being long the airlines. But the airlines, from a tactical perspective, certainly looks like it's gathering a little bit of strength here. Can this continue? I would want to see a breakout above 19 on the JETS ETF, which is predominantly global airlines here. If we can break back above 19, especially as you start to head to that 200-day moving average, that could be that long term. As you can see, there's a lot of upside here. So from my perspective, I would be a little bit more conservative on betting on the airlines. Wait for a breakout above these levels because you have plenty of upside here to be, as opposed to being opportunistic, if you will, and trying to pick a bottom. So with that covers what I want to share with you here this morning. I hope that you guys find this useful in helping you start out your day and giving you a sense for the directional outlook of the broader equity markets. It's important where we currently sit, again, at a very pivotal moment. So keep an eye out for those levels, and we will keep you updated here at OptionsPlay. Thank you so much and have a great trading day.